Welcome back to the deep dive, or maybe I should say welcome to Griffonomics.
Griffonomics, I like that. It sounds serious.
It has to be. We're not just skimming the headlines today. Think of this as more of an investigative report.
Mm.
We're looking at an industrial giant that, if you haven't been paying super close attention, you probably still think of as a boring, old-school truck parts company.
Right? Making transmissions, clutches, the whole Rust Belt image.
Exactly. But today is February 3rd, 2026, and they just dropped their Q4 2025 earnings. And let me tell you, the script hasn't just been flipped, it's been completely shredded.
It really has. I mean, when you look at the numbers they just put out, you're not looking at a traditional manufacturer anymore. You're looking at what I've started calling the central nervous system of the whole AI revolution.
That is a huge claim. We are talking, of course, about Eaton Corporation, ticker ETN. And our mission today is to really unpack this massive pivot they're on. They call it intelligent power management.
Which sounds like a mouthful of corporate buzzwords.
It does. But our job is to figure out what it actually means for the bottom line. So we're going to dissect this earnings report. We're going to talk about the huge strategic breakup they just confirmed, and frankly, the risks hidden inside what they're calling the cost of growth.
And there is a real cost. The headline numbers look great, but when you dig into the details, you can feel the friction.
Oh, we'll get to the friction, trust me. But first, let's just set the table. We have the Q4 report in front of us. So strip away all the marketing fluff. What does Eaton actually look like right now?
Okay, to get the modern Eaton, you have to sort of ignore the old transmission business for a minute and look straight at the engine room, which is Electrical Americas.
Okay.
This is the segment that handles the North American power grid, data centers, industrial electrification, and it is the absolute star of the show.
Define star for me. What kind of numbers are we talking about?
In just the fourth quarter, this one segment grew 21% total. For a company this size, that's like moving at light speed. But, the number that really blew me away isn't what they shipped. It's what they're waiting to build.
The backlog.
The backlog, exactly. It's basically their book of future business. It's at a record $19.6 billion total. That's across electrical and aerospace. But if you just zoom in on Electrical Americas, its backlog jumped 31% year over year.
31%. I mean, that just screams a massive supply-demand problem. It sounds like they literally can't build the stuff fast enough.
That's the story right there. And it's not a blip. They even talked about their negotiations pipeline. That's the work they're bidding on for the rest of the year, and it's already at nearly $10 billion. So this demand curve isn't flattening, it's getting steeper.
So Electrical Americas is the growth engine, but they're a global company. Is the rest of the world seeing this, or is this really just a U.S. story?
That's where it gets a little more nuanced. Electrical, global, so Europe, Asia. It's a different animal. It's not growing as fast. It clocked in at around 10% growth, but they are running a much, much tighter ship.
Tighter ship meaning more profitable.
Way more profitable. They expanded their margins by a massive 200 basis points. They hit 19.7%. I mean, in manufacturing, squeezing out an extra 2% margin in a year is incredibly efficient.
So Americas is all about speed, and global is all about discipline.
That's a great way to put it.
Okay, so we got the electrical side. But there's another piece of this that I feel like always gets lost because everyone is so obsessed with data centers. Aerospace.
Ah, the hidden gem. Aerospace is the ballast in the ship. While everyone's hyping up AI, Eaton is still this major player in, aerospace and defense hydraulics, fuel systems. And this quarter was just stellar for them. 14% sales growth, and 12% of that was organic.
So they earned it. They didn't just buy it.
They earned it. And the margins,
Let me guess. High.
huge, 24.1%. For a hardware business, that is fantastic. And a lot of that is defense work, which is very sticky. It gives them this great safety net for the whole portfolio.
Okay, so that's the picture today. A hot electrical business, a steady aerospace wing. But the real headline, the breaking news, is this massive corporate divorce they just confirmed.
The strategic inflection point, yeah.
They first mentioned it on January 26th, but now it's official. The mobility spinoff. This is the old truck business we were talking about. So walk me through it. What's happening?
They're essentially breaking up with their own history. They are spinning off their vehicle and e-mobility segments into a brand new standalone public company. The target for this is Q1 of 2027.
And for you, the shareholder, it's structured to be tax-free.
Yeah.
But the real story here isn't the tax code, it's the why. This is a classic case of addition by subtraction.
I always find that phrase a little funny. How do you get better by just lopping off a huge piece of your company?
It's all about the quality of that revenue, not just the quantity. I mean, think about it. The
Yeah.
mobility business, the truck parts, it's super cyclical.
Hmm.
When the economy slows down, trucking fleets stop buying. Margins are stuck around maybe 13 to 16%, and the business only grows at like 2% a year. So a GDP plus business at best. Now compare that to the electrical side.
Exactly. The electrical core is hitting 26% plus margins, and it's growing at 12%. So you have this high-speed, high-margin business being dragged down by the slow, low-margin one.
You cut the cord.
You cut the cord. It's like cutting the sandbags off a hot air balloon. The remaining Eaton RemainCo instantly looks like a much better company, and the new company, SpinCo, will be fine. It'll have about $3 billion in revenue, but it lets Eaton focus 100% of its energy on intelligent power.
Which brings us to my favorite part of the report, the data center gold rush. This feels like the main event.
It is absolutely the main event. This is where the valuation multiple is coming from.
I saw one number in the press release that, I have to be honest, I thought was a typo. The data center orders in Q4.
You saw the 200% number.
200%, is that real?
It is not a typo. Now, actual sales grew about 40%, but the key detail isn't just the volume, it's the mix. In 2025, half of their data center orders were specifically for AI projects.
Hold on, what's the difference? AI versus, what, traditional cloud?
Exactly. Think of traditional cloud as your Gmail, your iCloud photos. That's storage and streaming. Historically, that was 70% of the business. Now, AI is half the new orders, and that matters because AI data centers are totally different animals.
Different how? Just more servers.
It's all about density. AI training clusters they are power-hungry, heat-generating monsters. A traditional server rack might pull 10, maybe 15 kilowatts. An AI rack with the new NVIDIA chips, that can pull 100 kilowatts or more.
And more power means more equipment for Eaton to sell.
They love it. They even track these things called mega projects, which are construction jobs over $1 billion. They have a $3 trillion backlog of these projects, and data centers now make up 54% of them.
Okay, I want to drill down on this idea they mentioned, a content multiplier. Break down the math on that for me.
It's really simple math, driven by physics. Because AI needs so much more power and creates so much more heat, you need beefier equipment. Everything is bigger. So, for a traditional data center, Eaton figured they could sell about $2.9 million of gear for every megawatt of capacity.
Okay, 2.9 million a megawatt. What is it now with AI?
Now, it's jumped to $3.4 million per megawatt.
Wow, so that's an extra $500,000 for every single megawatt just because it's an AI project.
Correct. And the key is where that extra money comes from. Eaton used to just do the stuff outside the building, the gray space. Now they're moving inside, to the white space, to the actual server hall. They call it grid to chip.
Which is the perfect lead-in. How? How does a company that makes circuit breakers suddenly get inside the server rack, touching the most advanced chips on the planet? It seems like the answer is a very, very expensive shopping spree.
A $13 billion shopping spree, to be exact. They're not building this tech from scratch. They are buying it.
Okay, let's hit the big ones. The 10-ton gorilla is Boyd Thermal.
Boyd Thermal, this is the big bet. A $9.5 billion deal that closes in Q2.
Almost $10 billion. For those of us who aren't thermodynamics experts, what does Boyd do?
Liquid cooling. We said AI chips get hot, right? You can't cool them with fans anymore. You just can't. You need to run specialized liquid directly over the chip to pull the heat away. Boyd is a leader in that inner loop technology, cold plates, manifolds, the whole system.
So by buying Boyd, Eaton is literally on the chip.
That's it. That's how you get from 2.9 to 3.4 million per megawatt. They handle the power from the utility all the way down to the cooling plate on the silicon. It's vertical integration on a massive scale.
But they didn't stop there. Fiberbond, 1.4 billion. What's that about?
That's a totally different play. That one is all about speed. Fiberbond makes these modular power enclosures. Think of it like a prefabricated house, but for a data center's electrical room.
So you just truck it to the site and slug it in?
Precisely. In this gold rush, speed is everything. Microsoft, Amazon, they want these things built yesterday. If you can shave months off construction time by dropping in a prefab power station, you win. Eaton is selling time.
And then there was Ultra PCS, another $1.5 billion.
Right, and that just goes back to the aerospace business. It's mission-critical defense tech, bolstering that high-margin safety net we talked about.
Okay, so if I stop the story right here, it sounds perfect. Record sales, crazy growth, getting rid of the slow business, buying the future. But, and there's always a but.
Always a but.
The stock stumbled a bit today. And if you look really closely at the Electrical Americas margins, the engine room, they actually went down.
They did. And this is the reality check. Their margins compressed by 180 basis points, down to 29.8%.
Which is a huge drop when you're growing that fast. I mean,
Right.
usually you get economies of scale, right? You sell more, margins go up. So why did they go down?
It's a paradox. They have too much demand. They cannot make the stuff fast enough. So they are buried in what they call ramp-up costs.
I saw they're deploying Tiger teams. That sounds cool, but I'm guessing it's very expensive.
Very expensive. A Tiger team is basically a special ops unit of engineers that you airdrop into a factory to fix bottlenecks. They're hiring like crazy, paying tons of overtime, expediting shipments with air freight instead of trucks. They're throwing money at the problem to clear that backlog.
So they're choosing speed over efficiency.
They have to. And management was very upfront about this. They actually quantified it. They are guiding for a 130 basis point headwind to margins for the full year in 2026, specifically because of these costs.
So they're taking a profit hit now to build capacity for the long term.
That is the bet. You take the hit now to lock in the market share. Because if you can't deliver, your customers will just go to your competitors, to Schneider or Siemens. You have to bleed a little now to win the war.
Which brings us to the risks. Because this all makes sense, but it really feels like they're juggling chainsaws right now.
It's a lot of moving parts. I call it the tri-tasking risk.
Tri-tasking. Okay, lay that out for us.
Well, just think about the to-do list for the CEO right now. Task 1, spin off a $3 billion public company. That is a logistical nightmare.
Sure, all the IT systems, HR, everything.
Exactly. Task 2, integrate $13 billion in very complex M&A. Boyd isn't some small company. It's a huge global organization.
And task 3.
Build $1.5 billion of brand new factories from scratch, while simultaneously sending Tiger teams into your old factories to fix the backlog.
Any one of those would be a full-time job, doing all 3 at once.
It just screams execution risk. If they drop one of those balls, if the spinoff gets messy or the integration goes badly, it could be really costly.
And the market is not giving them any room for error, is it?
No, not at all. That's the valuation risk. The stock is trading at around 30 times trailing earnings.
For an industrial company, that's pretty rich.
It's very rich. It's priced for perfection.
Meaning everyone already assumes this is all going to work out flawlessly.
Right. And their 2026 guidance was solid. Don't get me wrong, 13 to 13.50 in EPS, up 10%. But it's not a blowout number. If they stumble on that execution, the stock has a long, long way to fall because all this success is already baked into the price.
So we've covered the pivot, the boom, the spending, the costs.
Yeah.
What is the final Griffonomics verdict on Eaton?
Strategically, it is a slam dunk.
You'd call it a must-own.
For the next decade. Absolutely. The utility-to-chip strategy is, I think, unique. I don't see anyone else with that full span from the high-voltage grid all the way down to the liquid on the chip. They're building a very powerful moat.
But tactically?
Yeah.
For someone looking at the stock right now,
Tactically, I'd be more careful. I'd call it a high-quality hold, maybe even a speculative hold.
why not a buy today?
Because of that margin noise we just talked about. I think Q1 and Q2 of this year are going to be messy. You're going to see all those costs, the spin-off, the integration, the ramp-up. I'd personally wait for the smoke to clear. Let them get through the messiest part.
So don't chase the headline. Wait for the inevitable dip.
Exactly. Risk defined. Portfolio protected. That's the whole idea. You want to own this company. You just don't have to pay 30 times earnings for it while it's still a construction zone.
That makes a lot of sense. Transformations are rarely a smooth, straight line.
Never.
Okay, before we go, I want to leave you with one final thought that was just nagging at me reading all of this. We talked about a $3 trillion backlog of projects. We talked about data center orders up 200%. We're building these monster AI factories.
Right.
Eaton sells all the gear to connect the power. But here's the question. Can the U.S. utility grid actually supply enough power to turn them on?
That is the trillion-dollar question, isn't it?
Eaton can sell you all the switchgear in the world, but they can't generate the electricity. We're seeing this 30% backlog growth for projects, but the grid itself, it's not growing at 30% a year.
Not even close. You've got aging infrastructure, permitting that takes years, a lack of new power plants.
Which means the ultimate bottleneck for this whole AI supercycle might not be the chips or the cooling. It might just be the electrons themselves.
It's a sobering thought.
Something to think about. This has been a custom deep dive into Eaton's transformation. Thanks for listening to Griffonomics.
Thanks for listening.